On one day in April of 2015, Jeff Bezos got nearly $5 billion richer, and by the end of the week, he was more wealthy than 3 out of the 4 Walmart heirs. What happened was that Amazon had just released its newest earnings report, and they had finally broken out numbers on a small side business they had been working on called Amazon Web Services. Amazon had run AWS for nearly 9 years by that point, but had never explicitly reported the numbers. Wall Street guessed that this business actually lost some money, but the report said otherwise. In fact, revenue had grown nearly 50%, with margins around 17%. Amazon as a whole had lost $57 million. Amazon Web Services had gained $265 million. The stock jumped 14% to an all-time high. That's $25 billion of trading value in one day. The market learned what kind of business Amazon actually was. It wasn't a retail business. It was indeed a tech company. And matching tech company multiples, analysts quickly realized that they had highly undervalued this business. In today's episode, we're going to be talking about multiples and comps. If you're new here, I'm Michael. I'm the founder of OFFERGOBLIN, ex-Centerview, UChicago dropout, and I make videos on how to get into investment banking. This is a part of a technical series. In the last episode, we covered enterprise and equity value. But today we're going to put those numbers to work with our first real valuation method. There's a completely free guide to how that's done in the description. It serves as a supplement to this episode. So today we're going to cover why bankers use comps, what a multiple actually is, how peer groups are picked out, the 3 multiples that you'll need to know and do most of the work, why some line items pair with enterprise value and some only pair with equity value. We'll also cover a real city interview question. So stick around, and if you find this useful, please like and subscribe. You can also find us on Instagram and TikTok and LinkedIn. Valuation sounds like it'd be very deep math, but most of the time you're really just asking, what is the price of this thing? Which really means, what is it currently selling for? Think about the way that a house actually gets priced. Nobody's really forecasting a house's future cash flow or breaking down the materials. They're typically going to look at the neighborhood and look at what other houses are sold for, and then compare it on a square foot basis. In mergers and acquisitions, you're looking at businesses the same way that you'd look at a house. You're looking at a bundle of assets and liabilities and equity and saying, how much will someone pay for this? And the best way to get to that number is to compare it to other businesses which have sold or are trading, and compare it on some kind of unit basis that makes sense. One of the nice things about it is that it's fast, it's current, and it anchors on real prices that buyers have actually paid. Whereas a forecast can bake in a lot of opinion and assumption about what will happen in the future. It's also critically important to investment banking interviews that you understand this. It'll underpin your ability to talk about deals, but also many investment banking interview questions use multiples. You'll need to understand them. A multiple is a per unit way of valuing a business. It's a fraction, and in the numerator is a price tag. There's 2 of them, enterprise or equity value, like we covered in the last episode. And in the denominator is a type of earnings. It could be revenue, EBITDA, net income. And what this fraction represents is the price to purchase $1 of that earnings. But there's a trick. Not all numerators go with all denominators. And I'll give you the trick of how to remember this for your investment banking interview. For enterprise value, you can only pair it with denominators, earnings numbers, which have not yet been impacted by debt. So things like revenue and EBIT and EBITDA. Equity value, on the other hand, you have to do it on line items that are below the impact of debt. So net income, for example. But what's really interesting is that the bottom doesn't actually have to be earnings. It can be some other operational metric. For data centers, oftentimes they'll value it on a gigawatt, or real estate trading on a square foot basis. But every multiple still means the same thing, which is, how much does it cost to acquire 1 unit of whatever that is in the denominator? All right, a company trades at X earnings. Is that a good deal or a ripoff? Well, standing alone, that number tells you nothing. $400 a square foot is a deal of a lifetime in Manhattan, but it's robbery in Hyde Park, Chicago, where we are. Same number, different neighborhoods, opposite verdict. Cheap and expensive are always relative. So here's the move. We're going to find businesses like this one, and we're going to pull their multiples, and we're going to see how our multiples stack up. Here's a great question about comps from Moelis. They ask, if you were valuing an orange farm, would you include an apple farm in the comps? It's really a trap to answer this question yes or no. So we'll give the classic consulting response that it depends. What's important in an interview is that we can actually back up the it depends. So it depends on a few things. First of all, do we have enough other comps to where we don't need to use this apple comps? Because if so, let's just throw it away. But if not, maybe apple farm is the closest thing to orange farm that we can get. And if you think about it, there's probably a lot of similarities. They're in the same industry, they have the same business model. It could be comparable size, it could be in the same part of the world. So the important thing to remember about comps is that there's never a clear answer, and it's more about your ability to defend and explain it. Ultimately, these comparables are going to be used to make some kind of a judgment call. And all you can say is that this is the best data available to give us the best possible comparable estimate for an orange farm. You could hypothetically come up with an infinite number of multiples, but there's really three that carry a lot of the load, which you should know very well. The first one is EV over EBITDA, and that's the whole business price tag over operating earnings before any finance choicing and depreciation. This lets us compare two companies no matter how they're financed, because financing is a choice and usually not a fact of business. Number two is EV over revenue. And this is sort of the benefit of the doubt. A lot of times this is for companies with no profit to divide by. Let's say they have negative EBITDA or they have negative net income. It just prices the sales and takes the margin on faith. And third, the last one is price to earnings. This is the classic PE ratio that you see on Yahoo Finance. And that's really the shareholder price. How much does a shareholder pay for $1 of net income? The way you can also get to this is market cap divided by net income. These three multiples do most of the work in finance. Know them well, and you'll be able to navigate most investment banking interview questions about multiples. Here's the thing most people get wrong about multiples in investment banking interview, and that is pairing the wrong price tag with the wrong line item. The critical way to think about it is whose money is this? If it's money that belongs to everyone, then it's enterprise value. If it's money that belongs only to equity holders, then it's equity value. So you'll get questions like, which one of these multiples doesn't belong? And you'll see things in there like EV over net income. Well, why doesn't that work? Well, by the time we get to net income, we've already subtracted what's owned by debt holders. Net income is only what's owned by the shareholders. So two identical businesses with different debt would print wildly different numbers. Now let's flip that. What's equity value over EBITDA? Well, that doesn't work because equity value represents the shareholder's ownership and EBITDA hasn't subtracted out debt yet. So the core thing to remember is that above the interest line, you're looking at enterprise value. Below the interest line, it must be equity value. Match the price tag to the people the money belongs to. So let's talk about why margins would differ. So two companies, same industry, same size. One trades at 10x EBITDA, the other trades at 9x EBITDA. The interview question would be why? Well, a multiple is compressed information. The market's opinion of a business squeezed into one number. So when two multiples differ, the market's opinion differs, and there's three main reasons why that would be. The first one is growth. $1 of earnings that's growing is worth more than $1 that's standing still. You're buying the whole future stream price today. The second is margin. If more of every dollar of revenue survives to profit, then each dollar of sales would be worth more. Better engine, higher price per unit. And the third is risk. Let's say there's 3 customers that one business has and 30 that another has. That's a lot of risk if they lose one of them. The shakier those earnings are, the less anyone pays for $1 of them. In practice, leverage also factors into this. Enterprise multiples are supposed to shrug at financing, but a business drowning in debt will trade at a discount anyway. So in the example of Amazon releasing their AWS earnings, the market popped because they realized that the margin of that very fast growing business was super solid. And it made them realize that Amazon should actually be at a software multiple instead of a retail one. So when multiples differ, look towards growth, margin, and risk. Oftentimes in interviews, you'll just be asked to hypothesize why you think these are different. And having this framework will give you a chance to speak intelligently on that topic. A tricky question that Lazard has asked candidates is they'll give you a set of comp analysis and they'll say, what's wrong with this? Here are the types of errors that are usually hiding in there. For one, the target sitting in its own comp set that would drag the median towards the business itself. The company you're valuing should never be included in its own peer group. The next thing is basic count instead of fully diluted share count. You need to make sure that the equity value is actually right, and you'll need to use the diluted share count in order to do that. Another thing would be mixed time periods. So making sure that you're picking the same quarter or year, pick a period and have every comp fall in that period. And the last thing is, it's a little tricky, is having one-time items still be included. Sometimes businesses will have one-off expenses based on a disaster that happened at the business or a lawsuit or something, and you don't really want to bake those into the comp set. It's going to skew things quite a lot. You really want to strip away what's not going to repeat. So you can see that Lazard Super Day question linked in the description. It's from, I believe, New York. Ultimately, finding errors in comp sets is just going to require you to understand what a proper comp set is, and then just be thorough in checking all of those details one by one. I'm going to expand the scope just a little bit here just to talk about some related valuation topics. So we've been talking about multiples and comps in most part in the context of trading comps, meaning looking at other publicly traded companies. But there's two other ways of valuing, and we're going to get into those further in future episodes, but it's important to reference them now a little bit. So we have our trading comps, we have precedent comps, which would be comparing to other businesses which have sold before, and we can use the multiples from that as well. And then we have the DCF, which is the discounted cash flow, which would give us an overall net valuation of the business, not a multiple. In practice, when we're actually valuing a business, we're going to be running all three. So even though this episode focuses primarily on multiples and trading comps, keep in mind that we never really just use one form of valuation. Here's how to value a company using trading comps for an investment banking interview in 60 seconds. Step 1, pick the peer set. That's public companies in the same business with similar size, growth, and margin. Step 2, spread their multiples. EV over EBITDA, EV over revenue if profits are thin, and P over E for the equity view. 3, take the peer median and apply it to your company's matching metrics. That should be your implied enterprise or equity value. And 4, bridge it home. If you have enterprise value, subtract net debt to get equity value, and then divide by diluted shares outstanding to get an implied share price. 5 is to say where you sit relative to the median and why. Growth and margins are going to push you above that median. Risk and leverage are going to pull you below that median compared to your peers. Step 5 is the difference between doing the math and doing your job. And if you get that right, you may have a shot at an investment banking career. All right, so that's trading comps. There's a bunch of practice problems in the description. And if you get on OfferGoblin on an accelerated plan, you can go to topics and sort by different multiples to see how banks ask questions about it. If this was helpful to you, please like and subscribe. You can find us also on Instagram, TikTok, LinkedIn. But otherwise, I'll see you next week.